Hello, everyone, and thank you for attending our Chugh CPAs LLP webinar today. We hope that everyone is staying safe during this difficult time. The coronavirus pandemic has upended our normal ways of doing business and planning for your financial future. Luckily, there are certain strategic planning opportunities that businesses and individuals can leverage. Today, we'll be sharing critical financial, estate, and tax planning opportunities available during the pandemic. As you may already know, Chugh CPAs LLP is a full-service accounting, tax, and audit firm serving businesses and individuals with 6 offices across the United States and affiliates abroad. For more resources to help you navigate the funding, tax, and other uncertainties of the pandemic, please be sure to visit the COVID-19 sections of our websites on chugh.com and chugh.net. Today, I'm honored to present our panel of experts who are experienced in coming up with innovative financial and tax planning strategies. Joining us today, we've got Subhash Desai, Senior Partner from our Santa Clara office, Komal Kabra, CPA from our Los Angeles office, Shailesh Patel, Executive Director from our Atlanta office, and Jay Zhu, CPA from our Atlanta office. If at any point during our presentation today you have questions, please feel free to enter them into the Q&A chat box. First up today, we've got Komal Kabra, CPA in our Los Angeles office. Komal, could you tell us a little bit more about financial planning strategies that businesses and individuals can take advantage of during this time?
Sure, Shasha. So there are a couple of financial planning opportunities which I would like to discuss on. To begin with, we can start with small business loans, which involve Paychecks Protection Program, and it's an SBA loan that help business keep their workforce employed during COVID crisis. The Paychecks Protection Program resumed accepting applications on July 6, 2020. So the new deadline to apply for Paychecks Protection Program loan is August 8, 2020. SBA will forgive loans if all the employee retention criteria is met and the funds are used for eligible to small business and non-profit through Economic Injury Disaster Loan Advance Program. So having allocated the full 20 billion that was appropriated by Congress, SBA will discontinue making any EIDL advances to the new applicants. But EIDL loan applications will still be processed even though advance is no longer available. So one can apply for both PPP loan and EIDL loan. The amount of EIDL loan depends on your business and what the SBA determined is appropriate. Interest rate is 3.75% and for non-profit it is 2.75%. SBA will run a credit check. Loan is repayable over a period of 30 years. And the loan is prepayable at any time without penalty. Loan over 25,000 may require collateral and loan over 200K may require a personal guarantee. So what can we use the EIDL loan for? It can be used for working capital to continue operations, sick leave to employees unable to work due to the direct effects of COVID-19. It can be used for maintaining payroll, and it can be used for the increased supply cost, rent or mortgage payments. However, EIDL loan proceeds cannot be used to refinance debt incurred prior to COVID-19. The next financial planning opportunity which we can help business with is Main Street Lending Program. So on July 15, 2020, Federal Reserve released updated guidance for Main Street Lending Program. The updated guidance modifies or clarifies certain requirement of the loan. Following its launch on July 6, when the Boston Federal Reserve Board announced that Main Street Lending Program is fully operational. Approved lenders across the country are now accepting Main Street Lending Program applications for loans. The main requirement for business eligibility is having either 15,000 employees or less or 2019 annual revenue of 5 billion or less. It has a 4% maximum interest rate. It requires no repayment for 1 year. It can be used to repay other debt. It cannot be used to repay other debt, but must be used to pay payroll. However, there are limits on officers' compensation, stock repurchases, and declaring dividend. The updated guidance on July 15 reiterates that borrower must have financial record upon which a calculation of adjusted EBITDA can be made. EBITDA is earning before interest, tax, depreciation for 2019. And the updated guidance states LIBOR floor are not permitted. So the loans under Main Street Lending Program must be adjustable rate of 5-year term loan with an interest rate of 1 month or 3-month LIBOR plus 3%. So this updated guidance expressly provides that interest rate floor with respect to LIBOR are not permitted and the fees may be included in the principal. So a lender may charge certain fees to the borrower at the time a Main Street Lending Program loan is originated. Guidance clarifies that lender may include those fees in the principal amount of the loan itself, so long as the total amount including the fees doesn't exceed maximum loan size permitted to the borrower under applicable facilities of the loan. July 15 guidance also clarifies that eligible lenders and eligible borrowers may hedge interest rate risk related to the Main Street loan. So now let's move on to the next slide, where we have business forecasting models. So business forecasting has always been challenging, as we all know, and COVID-19 has shattered all the forecasting model. But the companies that incorporate external signals into their modeling by identifying drivers of the forecast, like considering what has changed due to the crisis, and then if the model rapid changes to external factors by using right data process, it can help companies identify opportunities during this time of crisis. While economic conditions may improve over time, which we all hope, some things are likely to change permanently. Many aspects of doing business, like from managing customer and supplier relationship to maintaining adequate levels of liquidity to predicting level of demands, may be very different from the way they were pre-crisis. So old ways of financial planning, forecasting, or analysis may disappear. We can help client in automating the manual process, provide strategic insights, and leveraging the tools that give a solid solution. How can we do this? We can conduct a rapid assessment of your current state of forecasting and scenario planning capabilities validating key assumptions through data analysis. We can develop rapid tactical models to deliver the analysis you need by ensuring forecast tool suite has the right scope and details of your business and lay out the impacts of the decision that are controllable. So this will help business provide them with the clarity that they need to navigate their way out of this crisis. And now moving on to the next slide, another financial planning opportunity is we should always try and see whether we can lock in at a lower rate or refinance now and save later, which we all have been hearing. And this is with relating to refinancing of your mortgage. So Federal Reserve dropped interest rate by 0.5 percentage point at the beginning of March 2020, and then dropping again mid-month to between 0 to 0.25%. So 0% is pretty attention grabbing. But one should keep in mind that it doesn't mean you can get a mortgage with 0% interest. And this interest rate shifting is basically an effort to boost the economy amid this crisis. What is refinancing in simple terms? It's a process of getting a new mortgage by changing the terms of the one you already have on your home. You might be thinking of refinancing your mortgage for a few reasons, like taking advantage of lower interest rate, or switching mortgage companies, reducing monthly mortgage payments, or using money for the refinance of a big purchase. Refinance doesn't mean you end up with two mortgages. Instead, your first loan is technically paid off through the refinancing process and second loan is created in its place. So we can help you do a break-even analysis to see if the refinancing is something worth doing in this situation. Getting a mortgage with 1 to 2% drop in interest rate can make a huge difference in one's monthly budget and ability to pay the mortgage later. Then we have student loan relief. So if you have a federal student loan, you can suspend your monthly payments through September 30, 2020 without any interest accruing. Also, employers can make tax deductible contribution of $5,250 towards your student loan payment this year. You will not have to pay tax on this contribution. I'd like to bring to your attention that this doesn't apply to private student loan or federal family education loan programs. So apart from all these, there are other financial plans which one must consider, highlights of which are like FBA Express Bridge Loan, SBA Debt Relief, and extra time to pay employer payroll taxes, like business owner can delay the payment of employer portion of Social Security tax, which is a significant sum. So we get a lot of extra time to pay them until December 31st, 2021 to pay a half of it, and until December 31st, 2022 to pay the other half. So these are a couple of financial planning opportunities which we should think of while navigating through this crisis. Over to you, Shasha.
Wonderful. Thank you for that overview, Komal. Up next, we have Shailesh Patel, Executive Director in our Atlanta office, who will share key tax planning opportunities that are available during this pandemic. Shailesh, over to you.
Yes, thank you for introduction, and Komal, thank you for all that good explanation about PPP and EIDL. So hello everyone, good morning and good afternoon, depending on wherever you are. So thank you to all the attendees to join our webinar for this all the details about tax, estate and financial planning. So I'm going to touch mainly on the tax topic. So myself, like I'm a tax professional enrolled with IRS and doing tax returns for business and individuals for 15 plus years. I can represent any business or individual client with IRS for any tax purpose. So with that, we will cover like few points, which is mainly for business and some of are there for the individual also. So the main one, like it is qualified business income deduction. And I'm sure like many of you already have come to know by now, sometime in the last quarter of 2017, so US government announced big tax cut and job act, which mainly to stimulate all this economy and give more incentive to the businesses to keep that more tax money for their own business growth. So this is like a very significant one, which is called qualified business income deduction, which is under section 199A, and the short form is QBI deduction. So I will recommend all of you just this has come into effect starting 2018 tax return. So I will urge, because based on our practice, we have come across like many individual tax return we reviewed for other client or even our client. So sometime like there is some possibility you might have missed out on this deduction. So the main kind of thing for this particular deduction is depending on your like pass-through entity as corporation or LLC or certain rental activity, sole proprietor business and things like that. So mainly everything but the C corporation. So based on that net profit from that particular business activity, you should be able to get up to 20% of that income as a deduction on your personal tax return. So which is very, very significant. So for example, if some small business owner, they have like many business and they are getting maybe 50,000 total income flow into their business. So make sure like you get up to 10,000 as a deduction. So just go back and check on 2018. Make sure if you are not done with 2019, you may want to consider talking to your CPA and just to maybe make sure you don't miss it, right? Couple of points on that. Yeah, so although like this thing is there, but depending on like a particular your service industry, there are certain kind of professional, for example, like doctors, lawyers, accountants, and many others. So given like their things, so they may fall under like certain kind of phase out. And the way it works, so when your total income on the personal return is more than 315,000, and this is I'm talking about merit file joint return. So when the income is more than that, and if you under that specified service thing, there is some possibility you will get like phased out of that 20% thing. So that will kick in at 315,000, and once something is above 415,000, you may lose everything, right? So based on that, like yeah, so and what we have seen, like there is another catch. So when things go on higher income, so at that time, like each particular K1 entity, so basically they should have a certain amount of W2 and also like whatever the real estate or property and everything. So there is another kind of complex calculation. So based on that, you should be able to get more deduction, right? So with that, we can request like if your particular business is kind of like having under payroll, so that can be like good strategy to kind of review that part and make sure like you are doing enough payroll for that particular entity so that you don't miss that 20% deduction on that. So that was the main thing on QBI. Just to add on the same part, like given this COVID situation, like a lot of given that a particular industry or business. So again, like a lot of people laid off and they are not ready to come back to work because of like health fear and all that part. So in that case, in order to use all your PPP loan, whatever you received for business, so there might be like some kind of requirement which says you should not kind of reduce your like manpower. So in that case, could be good strategy to consider hire a family from that point to make it to your PPP loan uses to full 100% deduction. Other than that, it may make sense and based on like our long-term experience. So we have seen like a typical small business enterprise person. So they are in the business for like 10, 15 years. So one person who owns like all that business, so he or she runs all that payroll only in one person, but they don't consider like doing payroll for the spouse, and which is not good idea. So they should have like payroll for both the people. So that way like both of them they can earn that social security quarters, which will be useful for their retirement. And just to add like one that the way quarter works. So by doing like simply like $5,640 for year 2020, so somebody can get 4 quarters of that social security. One more thing on that, like, yeah, so if you have like some maybe student child which is in the age 16 to 24, so it will be good to have like that his or her payroll run under your business. So based on that, you can reduce your income from the business and you can pay up to 12,200. So up to that limit, your student child won't have any income tax liability. Only thing they will pay social security, but still like it will be reducing from your high bracket to their low bracket. So that is something to consider on the higher family. The next point is charitable contribution. And as we know, like during this last 3 months since this COVID thing has started, so we get like a lot of changes on an ongoing basis, if not weekly, for monthly for sure. So a lot of things are changing. So you should keep in mind like few of these charitable kind of opportunity when we believe like, yes, during this unusual time, we want to help our community also, like as a business leader and all that part. So a lot of people like they are doing like a lot of contribution. So just for their update. So based on that 2017 Job Act, so that deduction limit increased from 50% to 60%. But one step ahead for 2020, when you do like charity contribution to qualified organization, then you can do up to 100% deduction on your taxes. And the main thing is like, yeah, you should pay that cash to the qualified organization, and this payment should be done in 2020. With that part, yeah, you can do like 100% charitable contribution deduction. One more thing, like other than this small business, so C corporations, right? Earlier, like that limit was like 10%. So C corp, they were allowed to do 10% of charity deduction, but for 2020 and especially for this COVID time, they can take deduction up to 25%. So that is a significant increase to bring it to everyone's attention. One more thing, like, yeah, so certain people like with having like a lot of connection with back home and foreign countries. So, and they also like support or do donation to that foreign organization. So by default, like when you give donation to foreign entity, it's not deductible, but there are like a lot of like local organizations. So they are established in US, but they are doing activities in a foreign country. So many of those organizations, you may want to like look for that and just use this charitable contribution benefit for your tax planning. The next one is small things like different kind of savings account to get the benefit on the personal tax return. And just to name few, like, yeah, one is HSA, which is a health savings account, and based on your employer plan and all that part. And you can also set up on your individual capacity also by talking to your bank or financial planner or advisor. So based on that, you can contribute up to like $6,900 for 2020 for a single plan, and for family plan 13,800 to get some benefit on the taxes. There are like certain other things for self-employed person, like which is MSA. Another thing is FSA, which is flexible spending account. HRA, which is health reimbursement account, and which can be very useful for the business people. So they can just maybe talk to their advisor to get like more detail, and that might be very useful. Just to add back one more point on the business part. So nowadays, like a lot of employees, they work remotely for the employers. So in this case, so employer can reimburse like whatever this home use and all that facility expenses while they work remotely, and that will be kind of business expense deduction. And at the same time, it won't be added to the W-2 of the employee. So that is something to consider for the planning. Next thing is 529 plan, which is very basic. This is like for the higher education saving. So where you can set up the plan for your child and to plan for that college fees thing. And generally, like, yeah, so you cannot get any tax deduction for the IRS federal tax return, but all the states, yeah, they give like depending on state, the limit is different and deduction. So for example, I'm based in Georgia. So in Georgia, you can do like a $4,000 contribution, and that will give you break on your Georgia return. One last thing is regarding contributions. So based on our experience, we advise client to do like a SEP IRA setup for the business, where they can just maybe company can contribute up to 25% of W2 and get the break on the K1 income to reduce their income, and at the same time they help owner employee to increase their kind of retirement fund. Two more things like regarding the regular thing, traditional IRA and Roth IRA, where the basic limit for 2020 you can contribute up to 6,000 in 2020, either in Roth IRA or in traditional IRA. If your age is 50 or more, then you can do $7,000. Regarding IRA, you can keep all that money. So that is something called like pre-tax and post-tax, two different things. So traditional IRA is pre-tax. So when you do the contribution, based on your total income on the personal return, you will get credit deduction on your personal return. But if the income is more than threshold, so that again, you should talk to your accountant and see like what will be to your advice, to your kind of advantage. When you see like there is no deduction benefit, then you may consider doing the Roth IRA, which is post-tax. Again, same thing, you can do one or both, or in combination, you can do 6,000 or 7,000, depending on that thing. One more thing, like especially for our maybe high income clients. So certain time they have like maybe professional doctor, for example, and their WT is like, who knows, 350,000, 400,000. So based on that income, they cannot do like straight IRA contribution. But what we have seen, like our client, they do like backdoor IRA, where they do like contribute to that regular IRA, non-deductible IRA, and do that rollover to Roth IRA to get the kind of bypass whatever the by laws to do the contribution. One more thing to add on that. So when you do contribution on that IRA, and if you happen to withdraw the money for XYZ reason, so there could be like a 10% penalty unless some like exception applies, depending on like valid exception. And we'll be happy to answer all that main thing if somebody had like more question. So Cesar, like that was my kind of presentation point.
Wonderful. Thank you for that overview, Shailesh. Next up, Jay Zhu, CPA from our Atlanta office, will speak on some exciting retirement fund planning incentives that every individual should take advantage of during the pandemic. Jay, could you speak a little bit more about some of these options?
Sure. Hi, everyone. This is Jay from Atlanta office. My topic is on tax planning on retirement fund, which is related to what Shailesh just talked about. During this pandemic, many people are suffering financially, and to be able to freely withdraw from a retirement account could be a good option. And thanks to the CARES Act, I'll be covering several changes on retirement fund plan today. Number one, 10% early distribution penalty waived for 2020. As Shailesh just mentioned, there is a 10% early withdrawal penalty if you want to take money from your retirement account, either traditional IRA or 401k. And if the person is under 59.5, usually there is a 10% penalty on top of the regular income tax. The new law temporarily waives the 10% early withdrawal penalty this year, and it is very good for us like taxpayer. The second point is tax due on taxable retirement distribution up to $100,000 in 2020 can be repaid over a 3-year period. It means, for example, if you receive a $9,000 distribution from a retirement account in 2020, normally you should report the entire $9,000 in 2020 income. But this year, you will have a choice of report $3,000 income for each of the 2020, 21, and 22. So it might allow you to fall into a lower tax bracket and save money on tax. In addition, you can also repay the entire distribution to an eligible retirement plan within 3 years. And you have the right to exclude this distribution from income. For example, again, you receive a distribution in 2020, and you choose to report the income over a 3-year period, which is 2020, 21, and 22, and they choose to repay the full amount to an eligible retirement plan in 2022. You may file amended income tax return for 2020 and 21 to claim refund, and you don't need to report the distribution in 2022 tax return. The next point I'm going to cover is loans from qualified retirement plans increased for 2020. Let's say, for example, if you need the money, but you don't want to withdraw from a retirement plan and pay tax, you can certainly borrow from your 401k plan. Normally, the maximum loan amount is $50,000, and the CARES Act increase the maximum loan amount to $120,000. Again, it's a very, very useful method to get the money you need now, and don't worry about any tax. In order to access all those three benefits which I just mentioned, 10% early withdrawal penalty waived, tax retirement distribution up to $100,000 2020 can be repaid over 3 years, and increased amount for loan from qualified plan. You have to be qualified, so it's not for everyone. Like you have to prove that either your spouse or your dependent diagnosed with COVID-19, or you have financial losses in the result of the pandemic. But the point I'm going to cover next is you don't have to prove that you get affected by the pandemic. It's called deferral of required minimum distribution for calendar year 2020. So what is a required minimum distribution, RMD? It means you cannot keep retirement funds in your account indefinitely. You generally must start taking withdrawals from your IRA or other retirement plan account when you reach age 70 and a half. The required dollar amount of minimum distribution is based on your age and the funds available in your account at the beginning of the year. Let's say, for example, if you do not take any distribution, or if the distribution are not large enough, you may have to pay a 50% excess tax on the amount not distributed as required. But under the new law, you don't need to take RMDs for this year, for 2020. If you already took a RMD for this year, you can roll back to the same plan or roll over to a qualified retirement plan. So if you don't take RMD, it will decrease your 2020 income and could lead you to falling into a lower tax bracket and avoid losses during market decline. And the last point I'm going to cover is Roth IRA conversions. Roth IRA conversion means you convert your traditional IRA to Roth IRA and pay tax now and save tax in the future. Since you need to pay income tax on a Roth IRA conversion at your current tax rate, if you're dropped into a lower tax bracket due to a lower income, you will pay less income tax on the amount you convert. You might need to consider doing more Roth IRA conversion this year. This end of my part, and I will pass it over to Sasha.
Wonderful, that was great. Thank you, Jay. Next up, we have Subhash Desai, Senior Partner in our Santa Clara office, to speak about estate planning opportunities that individuals can use to minimize taxes and fees on their estates. Subhash, over to you.
Thank you, Sasha. Estate planning under COVID-19, an opportunity to get your affairs in order. Uncertain times tend to generate attention to personal planning, particularly when one's estate planning documents have not been reviewed in several years. Due to changes in personal and financial circumstances, estate planning documents may not reflect one's current intentions or may be out of date relative to currently applicable law and financial status. Appointments under power of attorney or healthcare directives may also warrant review and reconsideration to ensure that decisions can be made on behalf of an individual who is unable to do so. It is also advisable to ensure that the successor have been named to assume that there is someone who is able to act, and the selection of appointees, some of which may be outdated or appropriate. Now let's talk about opportunities to engage in low-cost wealth transfer. The first one comes in mind is taking advantage of high estate and gift tax exemptions. The IRS announced that for 2020, the estate and gift tax exemption is $11.58 million per individual, while a married couple will be able to shield $23.16 million estate tax-free. This provision will expire on December 31st, 2025, and it may even end sooner with a new president. Let us explore the advantages of the gift tax exemption. Gift splitting election allows married couples to split the values of the gift between them and stay within the annual exemption amount. When assets given away, then growth on the assets is no longer included in the estate. Appreciating assets provide a carryover basis to the gift recipient, so any gain recognized by the gift recipient when the asset is sold will receive a long-term capital gains treatment of 15 or 20%, a significantly better rate than the 40% assessed at the estate level. With possible reduced investment and portfolio and real estate values, individuals motivated to pass along family wealth to younger generation may find that they can do so while using less of their gift tax exemptions and exclusions. These strategies may be further enhanced by the use of family entities such as family partnerships or LLC. We can also use intra-family notes. One family member can make a loan to another. In order to keep the transfer from being treated as a gift, there must be an obligation of repayment, ideally with a written agreement, and there must be a reasonable interest charged. Through an intra-family loan, the lenders, such as parents, get to keep the cash flow equal to the value of the assets plus interest in the form of repayments made by the borrower, in this case the child. If the cash is not needed, the parent can use the annual exemptions up to $15,000 per year per recipient in 2020 and lifetime exemptions to forgive repayments by the child. This forgiveness should not be the intent when issuing the loan, as the IRS would consider this as a gift. Assets in the hands of the child can then appreciate without inflating the parent's taxable estate, and the parent can keep the gift and estate tax exclusion to use towards their other transfers during the lifetime or upon death. Let us talk about shifting money into trust. It's a very smart way to shelter the estate tax. GRATs, a grantor retained annuity trust, a well-established technique that has been expressly approved by Treasury regulations, is a trust under which an individual retains an annuity interest for a term of years and leaves the remainder to his or her intended beneficiaries. For gift tax purposes, the values of the annuity is subtracted from the value of the property contributed to a GRAT, and only the difference constitutes a taxable gift. A larger annuity or one for a longer term will reduce the value of the taxable remainder interest. A GRAT is a strategy that benefits from a low interest rate environment. Let's discuss further. A low interest rate environment causes the GRAT annuity to be much more valuable actuarially than it would be if interest rates were higher. In addition, the exceptionally low hurdle rates and volatile market may create a unique opportunity to capture and lock in appreciation the GRAT assets without material gift exposure. If assets values are depressed, the opportunity may be even greater. It is generally more advisable for a GRAT term to be as short as possible to avoid the offset of short-term increases in value by a subsequent downturn. Creating various trusts, can save you money. A married couple may have a greater opportunity to make use of these tax exemptions by having each spouse create an irrevocable trust, creating a lifetime interest in the trust for other spouse, either at inception or in the future. There are ways to structure spousal trust to obtain the benefits they afford without causing the trust assets to be included in the taxable estate or of either spouse. If asset values are depressed and additional structuring is done by using family entities and transferring minority interests, there is significant potential for removing substantial wealth from couples' taxable estates. A married couple may also consider forming a marital deduction trust for one or both spouses to permit the current allocation of GST exemptions. Even though a marital deduction trust requires the current payment of trust accounting income to the spouse who is the beneficiary of the trust, the potential future growth of the trust principal may still provide an opportunity to reduce transfer on taxes on assets passing to the family. Another approach is selling assets to a grantor trust. An installment sale to a grantor trust is a possible way to remove assets from one's gross estate at a reduced tax cost. The settler would form and fund a trust with a portion of his or her gift tax shelter and apply GST exemption so that the trust assets would never be subject to transfer tax. Other tools available is for charitable planning using charitable lead annuity trust called CLAT. CLAT permits an individual to provide assets for charity for a period of years by retaining the opportunity to leave the remainder interest in the trust to the family members free of gift tax. As in the case of GRAT, the higher the amount of annuity and the longer its term, the greater is actuarial value for tax purposes, thereby reducing the value of taxable gift of the remainder interest. Also, as with the GRAT, the value of the annuity interest in a CLAT is higher when interest rates are low. This means the annual payment to charity will be relatively lower, potentially improving the chances of creating a substantial remainder interest for the family members. This is a very good way to pass appreciated value eventually to the family members. Now let us talk about retirement plan beneficiary designation and Secure Act. The effect of the Secure Act on the disposition of retirement funds beneficiary designation effectuating the disposition of qualified plans and IRAs may no longer achieve desirable tax deferrals. The use of a trust to receive qualified plan benefits or an IRA now require additional attention as stretched payment for all but few beneficiaries are no longer permissible. Beneficiary designation that transfer retirement benefits to trust under one estate planning document may require further review. All the planning needs to be done to be revisited in light of Secure Act. With a few exceptions, beneficiaries must now withdraw all inherited qualified plan assets within 10 years. For most beneficiaries, this will dramatically accelerate withdrawals and the period when the income tax will be paid. However, discretionary trusts estate are more likely to benefit from the 10-year rule. Under prior law, most trusts and estates had to withdraw 100% of qualified plan balances within 5 years. These trusts, however, were difficult to draft and administer, causing many to leave their retirement assets directly to individuals rather than trusts. Under the Secure Act, discretionary trusts are subject to the same 10-year rule as most individuals. This means in most circumstances, There is no longer an income tax penalty for leaving the retirement assets in a trust. With passing the Secure Act, there are many planning factors to consider. Trust beneficiaries is number one. If you did not name trust as a successor beneficiary of your retirement accounts to avoid the 5-year rule, you might reconsider that decision. As I mentioned earlier, trust and individuals are now on the same footing with regard to timing of the distribution of retirement assets. By leaving the assets in trust, you could provide your heirs an additional layer of creditor protection. If part of your planning involved providing for your child, who for whatever reason frequently faces financial difficulty, you can still use your retirement assets to provide a lifetime stream of income. One option is to leave your retirement account to a Charitable Remainder Trust, CRT, naming your child as a non-charitable beneficiary of the CRT. A CRT makes a stream of payments to a non-charitable beneficiary. Typically, those payments continue for a life of a non-charitable beneficiary. After the CRT completes making its stream of payments of non-charitable beneficiary, any remaining assets are distributed to the charity. Using CRT to replace the desired lifetime income from an inherited IRA isn't an exact substitute, but it comes close. The CRT isn't subject to income tax, and non-charitable beneficiary is only subject to the tax on the payments from the CRT as they are received. The tax deferral is quite similar. Under prior law, the beneficiary of an inherited IRA could choose to take out money more quickly. With the CRT, the assets are essentially locked in, so the beneficiary has to wait for the periodic distribution. This is a very novel approach and has lots of merits in certain circumstances. Well, this concludes my presentation on the advanced estate planning techniques. I hope you enjoyed it. Let us know if you have any questions and/or if you want us to be part of your estate planning team. Thank you. Back to you, Sasha.
Thank you very much, Subhash. Now we'd like to open our presentation up for questions. Please enter any questions that you have into our Q&A chat box, and I'll be happy to ask them to our panelists. We've already received a few questions about some loans for small businesses. The first question that we received is, can an employer use the PPP funds to supplement the income of a commission-only based employee? If so, what effect does that have on the PPP funds? I will pose this question to you, Komal.
Thanks, Sasha. That's a very good question. So as of now, there is no direct guidance on how commission-only based compensation is treated. But the analogy that may be helpful is that CARE Acts include a provision where it states borrowers may receive forgiveness for additional wages paid to employees. So the interim final rule on loan forgiveness also provided that payments to furlough employees would be considered as payroll cost, as well as if any bonus is paid, that will form part of the forgiveness. The intent of PPP loan is to keep people employed at the similar wage level. And if commission are no longer earned, then the amount that an employer allocates to full-time employees to make up the missing amount should be forgivable.
Great, thank you for that, Komal. Another question that I have for you is, when may a borrower who has a PPP loan apply for forgiveness?
Okay, so based on the revised forgiveness application and instruction, borrowers may apply for the forgiveness loan as soon as the applicable covered period expires. Covered period here means the 24-week or the 8-week covered period which the borrower may elect, and when their lender is accepting the forgiveness application. So borrower may not apply before the end of the applicable covered period. However, borrower must apply for forgiveness no later than 10 months after the end of its covered period. And
Thank you.
also, I would like to add to it that if the borrower does not apply for the forgiveness after the end of covered period and the 10 months has passed by, borrower will be obligated to begin paying principal and interest on the loan and may not participate in forgiveness.
Thank you for that, Komal. One more question that we received is, do independent contractors count as employees for the purposes of PPP loan forgiveness? Komal, could you help us with that one?
Sure, that's a good question. But yeah, the answer is no, because payment to independent contractors do not count as employees because they have the ability to apply for PPP loan on their own. So they do not count as full-time employee for the purpose of PPP loan forgiveness.
Thank you for that, Komal. Please enter your questions into the chat box. We will be here as time permits to answer as many questions as you have until our webinar end time at 12:30 p.m. today. So feel free to enter your questions into the chat box and we will be sure to answer them. Okay, it looks like we received another question here. If we have one CPA as a consultant, then he or she consults other associates. Do we need to consult each of the experts? It looks like this question was related to estate planning. Subhash, would you be able to answer this one?
Yeah, can you repeat the question?
Yes, so if we're using one CPA as a consultant and then he or she consults other associates, do we need to consult each of these experts?
No. For estate planning purpose, make sure that you have competent CPA or estate planner and a good attorney to draft those trust as you need it, and some complications are involved, so you need to have a good CPA who understands the trust laws.
Wonderful, thank you, Subhash. Any other questions? Please feel free to enter them into the chat box. It looks like that might be all of the questions that we have for now, but if you do have more questions that you didn't get the chance to ask during this webinar, please feel free to send us an email to info@chugh.com, or you can also send an email to one of our professionals. We have all of their contact information here on this slide. We want to thank you so much for attending our webinar today. And we wish you all of the best during this difficult time. Thank you so much, everyone, for attending.
Thank you, everyone.
Thank you.
Thank you.